If you remember, we have seen that the profit plan is based on several assumptions: the market size of the products and services, the market share of the company, the product mix, the prices at which the company planned to sell its products and services, the planned efficiency of the resources like materials and labor consumed per unit. In other words, the relationship between inputs and outputs, the unit cost of the resources that vary with sales and production levels, and the planned amount of fixed manufacturing and non-manufacturing expenses. If the actual profits do not correspond to the planned profits, then it is due to deviations associated with one of these assumptions. To identify the causes behind the above or below expected result, we can calculate some specific variances that will help to understand what actually happened in the last period. The overall profit plan variance can be divided into two types of variances: variances reflecting the competitive effectiveness of the firm and its operating efficiency. The former tells us how effectively the company operated in its markets, how it benefited or suffered from changes in the market size, how it reinforced its position against its competitors, if the company promoted the right mix of products, and if its pricing policies had a positive or negative impact on the financial result. The latter tells how well the company was managed internally in its different functions and whether it consumed more or less resources than planned. The analysis goes from the planned profit plan to the actual results, isolating one variance after another. It sounds complicated, but it is quite logical, assuming that we are rigorous in our analysis.